Welcome. This video covers gains from trade. We'll employ production possibility frontiers, yes, plural, using a two-country framework with no money. So that's where we get two production possibility frontiers, because we're looking at a two-country framework. There's no money. You can read an entire chapter on this in most textbooks, and there will be no discussion of money, and you won't even realize it, that there's no money in this economy that we're going to, in the economies that we're looking at here. We're trading goods for goods. We'll employ the concept of opportunity costs in this model. We'll look at and define absolute advantage and comparative advantage. And one of the key insights is this middle bullet here. We'll show that there are gains from trade if one country has a comparative advantage in the production of a good. And we'll get into that much more. Then we'll discuss boundaries of terms of trade. And what are terms of trade? Well, it's the price of goods in terms of other goods that are traded between countries. So it's, how many cars would you trade for, or how many computers would you trade for a car, or how many planes would you trade for a car? And so it's terms of trade is the price of goods in terms of other goods. There's no money in this model. And then we're going to show that trade is beneficial to both countries under the mutually beneficial terms of trade. So if we have terms of trade, which is the price of goods, that are within a certain boundary, we'll show that both countries benefit from gains to trade, hence the title of this video, the gains from trade. We'll find that if the prices are not within that boundary for terms of trade, then one country will benefit and the other country won't. Well, when that happens, there's not going to be trade because both parties need to agree to trade. It has to be beneficial to both. And if it's only beneficial to one, trade won't happen. So the point of it is we'll find the terms of trade boundaries and we'll look at, the motivation when prices fall within that boundary. And then we'll see how trade kind of stops when prices are outside of that boundary. So let's move on to the marker and paper to start analyzing these two countries that we're going to work on. So the purpose of this video is not only to teach you about gains from trade and where they come from and how to analyze the gains from trade, but to give you a bit of strategy on how to solve problems, because if you go and you look at various problems that are presented in various sources at the end of textbook chapters, you're going to find the data is presented in a slightly different manner, and you'll be like, wow, how do I transform this into something that I can use to analyze the gains from trade? Because it'll become quite unwieldy from different angles. So what I'm going to do is I'm going to show you one example how the information may be presented to you, but ultimately I'm going to show you how to transform it, what you need to transform it into to be able to nicely analyze gains from trade. So we're going to have two countries, the US and we're going to have India. And we're going to have corn production and we're going to have rice production. We're going to have 100 million workers. And this will be 100 million workers, per period of time. Just assume it's a year. And what we're going to say is you may be given data that says, look, how many workers does it take to produce a ton of corn? In the U.S., it might take one worker. It's one worker to produce a ton of corn. And it might take 3 workers, and that's a year. And it might take 3 workers per year to produce a ton of rice in the U.S. And in India, it may take 2 workers to produce corn and 4 workers to produce a ton of corn in a given year. Now, that's nice information, but what we want to do is we want to transform. Ultimately, you want to transform whatever you're given into output. And here's how you do it, and here's what it looks like. So you're going to have a table, and you're going to have corn, and you're going to have rice, 2 goods, India. And what we want to do is transform this to get this to be output. And so if we have 100 million workers and each worker can produce 1 ton of corn in a year, then if the U.S. devotes all its production to corn, it'll get 100 million tons of corn. in a year. And the same thing with rice. It's 100 million workers, and it takes 3 workers per year to produce a ton. Then we'll get 33.3 tons of corn, or sorry, of rice out of the U.S. if all it does is produce rice. And if we fill this out the rest of the way, there's 100 million workers in India also, so there's 100 million workers in each country. And so it's divided by the 2 here. We can produce 50 tons, and this will be 25 tons. Okay, so this is output by country and by commodity or good here. And this is the max. So if you just produce nothing but corn in the U.S., 100 tons. If you want to look at what's the output, if India devoted all its resources to producing rice, you'd be right here. 25 million tons of rice. Okay, now let's depict this graphically, because this is nice information in the table. But if we can transform it into a graph, it becomes, in my opinion, a lot easier to analyze. So what we want to do is, let's look, we'll do it side by side here. We're going to have the production possibilities frontier that I talked about, PPF. So this video here relies on the fact that you've looked at the previous video on production possibilities frontier. So we have 2. We have the U.S. production possibility frontier. We have India's production possibility frontier. And we're going to put corn on the y-axis, and we're going to have rice on the x-axis. Okay? And so what we're going to do is we're going to plot this. I'm going to try to plot it the best I can. We'll go to 100. This will start out at 100. That corresponds to the total output. If the U.S. just produces corn, right, it can produce 100 tons, 100 million tons. And if it just produces rice, it'll be 33.3 million tons. Okay, and if the U.S. decides to produce combinations of rice and corn, it'll be on this line. So remember, that line is the production possibilities frontier. Inside, if you produce some point inside, you're inefficient because you're not utilizing all your resources, and it's unattainable to get out past this frontier. Although you'd like to be out here, by itself, a country cannot get out in this area. Okay? And now India's frontier looks like this. India's frontier is, well, they can produce 50 and 25. So it's going to be 50 and then 25, something like this. Okay, 25 million tons of rice. And so there you have the production possibilities frontier that we saw in the previous video applied to this problem. And if you recall, what we were interested in is we were interested in that previous video on opportunity costs, and the slopes give you a hint as to what those opportunity costs are. Now this slope is 3 because you move over 1, you go up 3. Oh, I'm sorry, if you go over 1, you go down 3. So it's technically a negative slope. Let's get rid of the negative sign. Remember, the negative sign only tells you that there's a trade-off. You got to give up corn to get rice, or you have to give up rice to get corn. So we know that already, but what we want to do is we still want to calculate the slope, and the slope is 3. The rise over the run is 3, independent of the sign, and the slope here for India is 2. So remember how to interpret that, and the way to interpret it is, I'll write it out. The opportunity cost of 1 ton of rice is 3 tons of corn. That's for the U.S. This is for the U.S. now. So the opportunity cost of a ton of rice, and so rice is right here, is the 3 tons of corn. And so how does that work? Well, if you want to go in this direction and gain a ton of rice, you're going to have to give up 3 tons of corn. Okay, so that's the opportunity cost. And you can interpret this slope here of 2. For India, it would just be a 2 in place here. So we put it at 2 tons of corn for an opportunity cost of rice. Okay, so that tells you there's different opportunity costs there. And that's the key to this analysis, by the way, is opportunity cost or relative opportunity costs. Before we get there, let's take one little sidetrack that nearly everybody talks about. When if you look at the textbooks on gains of trade, and you listen to lectures on gains from trade, they're going to talk about 2 concepts. One is called absolute advantage, and the other is comparative advantage. Okay, let's cover this absolute advantage first. The absolute advantage basically says it is defined as the ability to produce a good with less inputs than another producer. And in this case, it's the ability to produce a good with less inputs than the other country, because the other country is the producer in this case, U.S. or India. So an absolute advantage, if you look at it, then our inputs here are 100 million workers for each country. So given we have 100 million workers, we actually can produce, to flip the concept around a bit, U.S. can produce more with the same quantity. So it's basically looking at this absolute value. The U.S. can produce more corn and rice than India, given the same amount of workers, the same inputs. Okay, so the U.S. has an absolute advantage in the production of both corn and rice because, look, compared to these two, the U.S. can produce more. Compared to these 2 numbers, the U.S. can produce more. So the U.S. has this absolute advantage. Now, the absolute advantage component, this is important because the absolute advantage part will give you no insight into trade and whether or not there are gains from trade. Okay, so that's a separate concept right there. It's not based on comparative advantage. It's not based on opportunity and costs at all. Okay, it's just who can produce more with the same amount of input or the ability to produce a good with less imports than another producer. Okay, so keep in mind that when you have this absolute advantage, it tells you nothing about the ability to trade, but what it does is it actually leads you down the wrong path, because you would think on the surface, you ask yourself, looking at this analysis, look, the U.S. can produce 103 tons of corn, 33 tons of rice, million tons of rice. Why would the U.S. ever want to trade with India? India is a smaller country in terms of its ability to produce goods and services. It can only produce, half the corn and a smaller amount of rice. Why would we trade with India? Do we have any advantages? So if you look at absolute advantage, it actually might mislead you into thinking, well, there can't be any gains to trade here. The U.S. should just stay put and produce its own corn and rice along here somewhere in a combination. But that wouldn't be correct, and that's where the concept of comparative advantage comes in. And comparative advantage deals with the idea that there are different opportunity costs, different trade-offs. And so what comparative advantage is going to help us analyze is who should produce what. Who has a comparative advantage? When I say who, which country has a comparative advantage in producing rice, and which country has a comparative advantage in producing corn? And so the way I look at it here, it's pretty simple. Once you have it graphed and you see the slopes here, you want to find the flattest slope out of the 2 countries here. Slope of 3, that's steeper than the slope of 2. So slope of 2 is the flattest slope. So let's look at India first. And since it has a flattest slope, what we want to do is we want to take what's on the x-axis here, and India, and what that will imply is, look, the rice is cheapest in India. And the reason why rice is cheapest in India, because it only costs 2 tons of corn to produce a ton of rice, whereas it costs 3 tons in the US. So rice is cheapest in India. And so let's assume for a moment that India will produce rice and specialize in the production of rice. And if India has a comparative advantage in the opportunity in producing rice, that implies that the U.S. has a comparative advantage in the production of corn. So that the U.S. should specialize in corn, India specializes in rice production, and then they trade. And because they specialize, then you can have resources that you can have your resources devoted to corn production or rice production, and you can produce more output. And then you trade. And then now the question is, what are the terms of trade that make sense? And what we're going to find out is the terms of trade that make sense, and we'll call it TOT, the terms of trade that make sense in this analysis is we want to find terms of trade, which is the price at which we're going to trade corn for rice between these two countries, is between the two opportunity costs that are presented. So the two opportunity costs presented here in this problem are 2 to 3. So if we can trade rice and corn between a price of 2 and 3, okay, 2 to 3 corn per rice, then we're going to find out that it'll be beneficial to both the U.S. and India to trade. And when I say beneficial, what that means is we can actually be out here to the right of this frontier for both countries, which means they can get to a place that's unattainable by themselves. And so that's where the gains of trade come from. Then what we'll see is if the terms of trade are outside of this boundary, terms of trade are above 3 or less than 2, then what we're going to see is that one country is going to have a gain from trade and the other country will not. It'll not be beneficial to the other country. And if that's the case, then no trade happens because you need both parties to have a benefit for them to trade. There's no reason for one party to trade if there's no benefit. So the point is, again, if we can trade between these two prices, there will be gains to trade, and the terms of trade will be between these prices. You're trading rice for corn. Remember, there's no money in this economy. And then if you're outside of this range, then there won't be any gains of trade. So let's proceed. Let me clean up this paper, and we'll move on to how to analyze this a little more. So here I've redrawn the production possibilities frontier, and at first we're assuming no trade. And so if we assume no trade in, let's say the U.S. wants to consume 50 tons of corn, 50 million tons of corn, which means it's going to produce and consume 16.67 tons of rice. It's going to be right at this point on its production possibilities frontier. Okay, so that's where we're starting. Now, let's assume that terms of trade are 5. They're not between the 3 and the 2 that we had here. Remember, 3 and 2, it's now 5. It's out of bounds, so to speak. We're going to see that one country is not going to want to trade, and the other country would love to trade, but if the other country doesn't want to trade because the terms of trade are too expensive and it goes against them, no trade will happen. It's got to be beneficial to both sides for the trade to happen. And so, let me get a different pen here. Let's start doing the analysis. Well, let's assume, again, that the U.S. wants to continue to consume this much corn. It consumes 50 corn, which means it's going to export 50. And so remember, when you have trade, you got to specialize. So the U.S. is going to specialize in corn and India in rice, But okay, so U.S. exports the 50 here. This is going to be imports of corn for India, so that matches up. And now what we need to do, given what we have, now keep in mind what's been given here. It gave you the terms of trade of 5. We know the slopes. We know the production when there's no trade. And I'm saying, look, the U.S. wants to consume 50, which implies it has to export 50 right here. So it's going to export 50. That comes over here. Now, given this setup, how much rice is India going to produce and export to the U.S., which means the import for U.S.? Well, that comes from the terms of trade. So the terms of trade are, look, we're going to have 50 units of corn here, right? We're exporting, right here, 50 corn. I should put this over here, by the way. Times 1/5 equals 10 tons of rice. And so why did I do that? Well, this is corn. And this is, now I got to flip this over. And so this is rice, the corn, so that then I end up with rice here. Okay, so this is the import to India. So they're going to produce 10 tons of rice for export. And so 10 tons of rice will come up right here. This right here is 10 export of rice, which means the U.S. imports 10, and it's going to be right here. Let's say it's about right there. That's 10. And this is 10. It's kind of hard to read. 10 import rice. Make sure you can see that. There you go. And so now let's see what happened here. Let's see India. India is going to import 50 of corn, and it's going to get 10. It's going to export 10 of rice, which means it's going to consume 15 rice, 15 tons of rice. It's basically about right here is where they're going to be consuming. They're outside of their production possibilities frontier. Let's pause for a second, move over to here before we review what's happening. Let's see what happens to the U.S. Well, the U.S. imports 10, which is this export, and it's going to consume this 10. This is what it's going to consume. It's going to consume 50. So the U.S. is basically right here. It's inside the production possibilities frontier. Like we said before, one country is going to do really well and another country is going to do not so well with this trade, and they're not going to want to trade. Here the U.S. is not going to want to trade. It's better off not trading at all, and if it doesn't trade at all, it could actually consume 6.67. This is 6.67 more tons of rice, million tons of rice. Well, why is that? The price of corn for rice is 3 here. But the price of corn for rice is 5 in terms of trade, which means the price of corn is really cheap. Corn is really cheap in this trade situation. So the U.S. has to give up a lot of corn to get a little bit of rice, is another way to interpret it. So it had an opportunity cost of 3. Now the opportunity cost is 5. And so that hurts the U.S. Well, for India is happy because they have to give up just a little bit of rice in order to get a lot of corn. So the price of corn has come down for India. So India really wants to trade. The U.S. doesn't want to trade. No trade. End of story.